it looks like the market is starting to finally swing long on gold. Again, the market is starting to finally swing long on gold. Here you get. Hey, buddy, this is Rob Keynes from goldsilverpros.com. It is November 11th, 2022. We're recording this about 11:30 noon Central Time. So all the prices that we talk about will be as of that time. This is your weekly market wrap and preview for the next week, and I want to jump right into it. There's a lot of news and a lot of things to talk about. Gold right now, as of time of this recording, is trading at $1,764.08 US. It's up $11 on the day. Across the last week, it's seen a nice climb from the low to mid 1600s to over 1760. So we've had a nice over $100 move in gold in the last week. That is nice to see. As of time of this reporting, silver is down a dime to 21.51 after rallying pretty strongly the last few days. It started off about a week ago, 1950. Now it's trading at 21.50, nice $2 move there. So both silver and gold have done pretty well as of late, while the rest of the market seems to be experiencing some problems. As of time of this reporting, and this will change by the time you see the video, but about midway through Friday, we're sitting down on the Dow Jones Industrial Average 0.74%, or down 250 points. The S&P is down 0.01%, or down half a point, about even really on the day. The NASDAQ's had a nice little bit of rally on the back of some bad news, some layoffs in the tech sector. It's at $70.85 up today to close, or trading right now at 11,184.99. The Russell 2000, the small cap index, has done well as well. It's up 12 points today, 0.65%, the exact same amount as the NASDAQ. It trading at 1880 right now. Some of the big news of the week: another crypto exchange goes down. FTX seems to be having a liquidity crunch, and they have stopped redemptions. Sam Bankman-Fried steps down as the FTX CEO as his crypto exchange files for bankruptcy, according to CNBC. Looking at the rest of the markets, the bond market has been a little bit sideways lately. The rates aren't too bad, even though we still have that yield curve inversion between the 2 and the 10-year, which is indicating a near-term recession on its way. The 2-year right now is trading at 4.33%. That's down 0.298 today. So it's actually a positive move for the 2-year bond. The 10-year is trading at 3.811. It was over 4% at one point. So I think some of the pressure has come off of the bond market. As far as the cryptocurrencies go, Bitcoin had a little baby recovery there and then has just been slammed down. It's down 777 points today, trading at 16,813.09. Ethereum is not doing much better. It's down 46 points to 1256.10. All of the crypto complex is down other than Litecoin, which seems to be up a point or so. Everything else looks like it's either down or trading even on the day. Looking at the major news economically, what came out this past week, the big one, of course, is going to be the CPI. It came under what people expected. The economic experts thought that it would cool a bit, down to 7.9% year over year. Our CPI is officially 7.7% year over year, which is a 0.5% less than what it was last month. The administration is claiming to victory, basically, over the fact that we had a lower inflation print, but I'll remind people it's still much higher than what we want to have and much higher than the federal funds rate. And so they're going to have to continue tightening the central bank will until they at least reach the CPI level, or we're probably going to go into a deep recession. We'll have to see what the Fed does going forward. The federal budget is a negative 88 billion for the month, which basically means they're running 88 billion short. Now, this time last month, it was 165 billion short. It's a little bit better, but we're still running big deficits, which does not spell well for the economy, especially with the underlying economic data not being too great. So those are the big data points that came out this week. Next week, we've got some major data points coming out. The New York Fed's going to give their 1-year inflation expectations and their 5-year. They're always lower than the actual inflation rate, but I like to look at that to get an idea of what the Fed is thinking in terms of its policy decisions. The producer price index comes out next week, and that tells us what producers are paying for prices and is a preview to what we may see in the CPI, or the end user or retail price increases, a couple of months later, because of course the producers will pay the higher input costs before passing them on to the retail sector. We'll get a lot of information next week on retail sales, auto sales, capacity utilization rate across the economy, home builders index, initial jobless claims, building permits, housing starts, existing home sales, and a bastion of different leading economic indicators. We'll be paying attention to that as we go forward. We're going to go ahead and get into the screen share, and we're going to talk to you about what's going on in the gold and silver markets. As always, I come to the CME Group and we look over at the data. Looking at the volume in open interest, in gold, we see gold right now trading at 1766.70, up 13 bucks on the day, or up 0.74% on volume of 162,027. Overall, we've had higher volume lately. And for the first time I can remember since covering this, all of these higher volume bars were for the most part to the positive side and not to the negative. Typically, when you see higher volume traded than average in either gold or silver, you see these bars above the average for the previous couple of weeks, like we see here. Usually that means more shorts have come in to short it. It looks like the market is starting to finally swing long on gold. Again, the market is starting to finally swing long on gold. Here you get the totals at the top, volume of 380,402, exchange for physical between COMEX and the London market 4851, which either means people are looking for 4,851 contracts of 100-ounce gold to be physically delivered, or they're playing arbitrage between the markets. These numbers have been very high, which I think means people are searching for gold on the market, may not be getting delivery on COMEX, and may be switching their positions over to London to get it. They could do that for a lot of different reasons. It's not as simplistic as they're just hunting for metal. It could be to offset or hedge other positions, or just for general liquidity. But when you have high EFP numbers, that generally means people are searching for physical delivery more than average. So we watch that number. If we go back to, that's Thursday's data as of where we're trading right now, or as of, what ended up yesterday. We don't have Friday's data yet. Looking back on Wednesday for gold, we had 292,766 contracts at close, EFP 2720, another high number here. Again, looking for physical. If we go over here to the settlement data, we can see what affects price. You can see here, December is the dominant contract for both gold and silver until the beginning of the year. That's where most of the contracts will trade. You can see that on the estimated volume. As of, this is yesterday's data on Thursday, so we closed down to 1753.70, up $40 on the day on the back of those 320,000 contracts. If you look at what happened on Wednesday, on the December contract, 253,787 contracts, down $2.30 to sell at 1713.70. The reason I show you this data is to show you where spot comes from. Where this settles at the end of the day is very close to spot. That essentially is determining spot within a fraction of a percentage point. You can talk about the arbitrage play between the US and London markets, and the London market and all that, determining spot and the fixes and all that. But at the end of the day, if you really want to know what spot's going to be within $1 or so on gold, you can just come here and look at this data. Silver is down so far today. Again, down 0.56% right now, trading at 2158 according to the COMEX data. If you look at the volume and open interest, we can see that we've had higher than normal trading this week. And like gold, it was to the positive side. Now that's rare. Usually when you see higher than average volume and open interest over a given 1 to 2 week period of time, it's usually for short selling to bring the price down. At least it has been since 2011, since we had record high gold prices in the last 11 years. That's been the pattern. We see here 2,500 contracts settled EFP, exchange for physical between COMEX and London. Again, people hunting for liquidity there, price arbitrage, and perhaps the physical metal. If we look at the dominant December contract, and this is data for Thursday, so yesterday's data, as you can see here, we had 76,900 contracts, not many actually, less than I would have expected leading into December, but still strong. And we had 2,400 exchange for physical deliveries. Total volume is very strong there. If we go back and look at settlements to see where the price is going, on settlements, 97,000 contracts. This is as of yesterday's data, closing 38 cents above to settle at 2170. And I just show this every week so you know what's happening. The next part I'm going to show you is actually the COT report. It's the commitment of traders. What the commitment of traders is it looks at all the big categories of traders that are trading within this block of data and breaks it down into a tabular format. We look at this for both silver and gold. This is backward looking. This data is the latest data from CFTC.gov. You can see in the URL bar up here. We're at their website live. This is the latest report, which is as of November 1st. Obviously, that's 10 days ago. And usually this week, or this report, I'm sorry, runs about a week to 10 days behind what you would expect to see in this data. This data is current The commitment of traders needs to be aggregated. It takes time. This is that report. And so we get this. And what this will tell us is the movement in these numbers down here in these rows will tell us why we have the current prices we have. So while backward looking, it gives us a lot of information on who's trading what. I always look at the major categories that are up here. You've got producer merchants, you have swap dealers, you have the managed money and other reportables, and then the non-reportables. Non-reportables are a bit of a mystery. Nobody can tell me who they are, including the CME group, but maybe they just don't want to tell me. Other reportables are things like wealthy individuals and family offices, managed money, or the more organized managed money hedge funds, other types of funds in this category, financial types. Swap dealers tend to be the bullion banks, the big four banks like the Citibank and Goldman Sachs and Bank of America and JP Morgan, for example, as well as some others. And then you have producer merchants. Producers are the ones that produce the metal out of the ground, typically the miners. The merchants are the ones who basically use it in their product. Producers are worried about falling prices because they need to get the best price for their product, so they'll take short positions. Merchants are worried about rising prices as an input cost of what they're producing, so they'll take long positions to offset that short-term potential rise in price risk, if that makes sense. All right. A lot of background data there. I like to give that every once in a while for those of you who are seeing this video for the first time. Those who've been following it for a long time, thanks for being patient. All right, what's happened? Well, you can see the producer merchants went a bit more short to about 2,500 contracts, no big deal. The swap dealers went net long about 1,000 contracts because they dropped about 1,000 less longs than short, but they liquidated positions across the board, 2,200 to be exact. The managed money is net long, more about 2,100 contracts. They actually took 597 long and dropped 1686 short. The other reportables have gone net short by about 600 contracts. Not a lot to talk about in silver, not any big moves, but certainly some positioning to be aware of. The swap dealers are net long, and so we think that they're the sharps or the smart money. They're like Vegas trading the house because they have all the data. And so we think the swap dealers generally indicate with their positions where they expect the market to go in the future, and they're generally right more than they're wrong. So this column is what I pay attention to the most. And usually these are sort of the dupes or the dumb money, because while there are a lot of intelligent people in managed money, they don't tend to follow the precious metal market as clearly. And a lot of times they take the other side and take the losses in the market, just the way it goes. Here's gold, same report, November 1st, same categories, don't need to reintroduce those. First thing I'm going to point out is the swap dealers for the last couple of months have been dropping shorts and adding longs. Now they did it in a muted way this week. It wasn't a lot. They added 3,300 longs and dropped 449 shorts for a net change of about 3,800 to the long side. There's still, however, about 65,000 contracts net short. So unlike silver, the bullion banks have not gone long, net, all of their positions, but they've been positioning long for a couple of months, which seems to indicate they think over the medium term that gold's price is going to rise. And of course, it has been this week. Why has it been this week? Because they're the ones taking more longs. So you see this report tells you what they're doing, which actually affects the price. This report and all this positioning and all these changes from long to short that you see on this row for each of the metals, this is what's determining spot price. This is the trade that determines the prices that I talked to you about here, and what you see when you go to gold price and you see your prices, or you go to your local dealer and you see your prices. It's all determined based upon the changes week to week here on this line and the COT report, which is why we go over it. So in the producer merchant category, net short, they dropped 2,400 shorts and 700 longs, so they went net long about 700 to the positive side. If you net all that out and do the math and take the absolute value of it, if you look at the swap dealers, they went net long about 3,800 contracts, adding 3,300 explicitly and dropping 449 shorts. Managed money did a whole lot of stuff on both sides. They bought 8,800 shorts and bought 6,100 longs. They're basically the lever in this market that the bullion banks and the producer merchants are using to take the other side of their positions. So anytime you see the producer merchants and swap dealers do something, the managed money just jumps in the other side. The other reportables basically have dropped longs and shorts, but they've gone net short a little bit here because they've dropped less shorts than longs. So they've gone net short about 800 contracts. Overall, not too much to know there about gold and silver, other than we do have some movement from the sharp money, the bullion banks going more long gold and already going a little bit longer silver. They're net long silver, net short gold, but moving net long. And that's why we're getting some positive movements in price, especially with gold as of late, and a little bit with silver, but a little bit to the lesser side with silver. Going to the ETF report, the reports I just went over highlight what's going to be aggregated in these lines here with the COMEX. So I just went over COMEX data. If you want to know what happens in London, most of, not all of these inventories in the middle part of the table are stored in London. Some are in New York or other places, but most of it's in London. So we look at this as like a proxy for what's going on in London. You can see overall that if you look overall at the gold trade, we have lost 3,600,000 ounces out of the US and London various depositories. And if you look specifically at the big fund, the passive investment fund, the SPDR, or what's known as GLD, and you click on this little link right here, it'll give you a little chart showing that there's been a runoff basically in GLD for a while and not a lot coming back in. So we think that GLD has been liquidated for ounces. Physically, the ounces are coming off. At the same time that there's repositioning long by the bullion banks in the derivative trade, positive signs for gold going forward. It means more than likely people expect gold to rise. Silver, basically the same thing. Here's the COMEX data. Net negative metals come off of silver instead of coming back on net. On the ETFs, with a little bit of a counter trend in SLV. Again, this is in the London market. If we look on this table, same as gold. Most of this is stored in London, some in New York and other places, but a good proxy for what we see in the London market. And if you go to SLV in particular, it's actually had an uptick. There's ounces come back in. Now they're still down 14 million ounces over the last 4 weeks. And net, the overall silver repositories in London and in the US are down 22 million ounces, but there's been a little bit of a rebound in SLV, not much. Some has come back in, some are buying back into it. And that's why you see a little bit of positivity on SLV, but still net negative for the market overall, and definitely net negative since the beginning of silver squeeze, which is this peak right here. People bought into SLV during silver squeeze, realized they were not going to get access to the metal because they're not an authorized participant with 50,000 shares. So they can't get the metal. And so they sold off, and then ounces came out of SLV. That's basically what happened. Wrapping up with the London vaults, you can see silver has come off. Now, when I look at silver here, and I say most of this is London, and you see all the ounces coming off, we can see that reflected in the aggregate chart on the LBMA. Now, the LBMA doesn't do a great job of breaking out all of the various ETFs. Nick Laird does that. That's why I use this chart here. But I also like to show it directly from the LBMA because you can see that they're confirming metal is coming off. They're now down 852,075 ounces from a peak months and months ago, 1 billion ounces. So they've sold off almost 300 million ounces in about a year and a half time frame. And so London is losing the silver as well. Overall, what does that look like? It looks like we had a little bit of a rally in the broad markets, which has not been particularly strong, with the Fed continuing to tighten, with some negative economic data coming out. Overall, the markets are still selling off a little bit, although we've had a little bit of a break, and the jobs numbers came out a little bit better than expected, although not as well as last month. And also because you've seen a little bit of positivity in the inflation rate, even though it's still high. That's given the market a little bit of reason to be a little bit optimistic. And if you count earnings season coming up with the holidays, Thanksgiving, Black Friday, and Christmas coming up, one could expect there to be a temporary or a little bit of a recovery as long as retail sales come in strong. And it's not all money being spent on credit cards, but people are actually spending free cash, and it's helping out the retail sector. We could see a little bit of a jump in some of the corporate earnings. The Q3 corporate earnings weren't great. A chart I put out on JM Bullion's blog and talked about on their YouTube channel recently was that since 2018, outside of a short recovery from the pandemic or a restart from the pandemic, we've had negative corporate earnings dating back to 2018. And the only reason for 3 or 4 quarters they were positive after the pandemic is because we restarted up. So we were starting from a lower number, even though we had never recovered to the number before the pandemic. So in other words, we had this much economic output, pandemic, then we started to recover, but never recovered back to where we were before. And so the numbers look positive because we went from a really low trough recovering a little bit, but they never recovered. And since we've had that little boost, the last 3 or 4 quarters, they've come back down again. So the overall trend for corporate earnings the last 4 years has been down, with a little bit of blip post-COVID that never made up for where we were in 2018 when we started that downward trend in corporate earnings. So corporates have not recovered. Labor force participation rate still in the 62% range. That has not recovered, dating back all the way to the tech crash in 2000. So fundamentally, the economy has not recovered from either its 2008 period or the pre-2000 period in a lot of these economic fundamental statistics, and which is why we cover them. We fully expect, however, at some point in 2023 that we'll figure out whether the economy is recovering and going to a recession. I wouldn't look at Q4 economic data as potentially saving the economy because Q4 always tends to be a bit bigger because of shopping season or retail season. We'll have to see how that retail season compares to previous retail seasons, whether we actually had growth and whether that's affected some of the economic fundamentals before we determine where we're going in 2023. Definitely think that most of the economic pundits and financial analysts are waiting for January, February 2023, especially post-election, seeing who comes into the House and whether the Republicans want it back or the Democrats remain control, what policies are going to come out of the Congress at that point. So I think people are holding their breath to see all of these things. And so I think that we'll get more of a resolution on where the economy is really going in the first quarter of 2023. We'll stay tuned. We'll stick with it and continue to do these reports as we go on. This will wrap it up for this time. Rob Kientz reporting for JM Bullion and for our channel Gold Silver Pros, the weekly market update.